Hello, everyone, and thank you for attending week 3 of BFSG's 3-week fall webinar series, today covering distribution strategies in retirement. As we begin, a few housekeeping items for all of you. I know this should be familiar for many of you that have been on our past series. There's a Q&A box in your Zoom menu for all of you logged on the computer, which is distinct from the chat box. As we go through the session today, please type all of your questions into the Q&A box, and we will address all questions at the very end of our approximately 30-minute presentation today during a live Q&A. For compliance purposes, during a live and recorded webinar, we will not be unmuting lines, so please type your questions into the Q&A box. Should your questions be more personal in nature, we will provide contact information at the end of our webinar today and encourage you to reach out directly rather than asking personal questions on a live and recorded webinar. The same registration link, as well as an automated email from Zoom tomorrow, will provide a replay link for a full on-demand replay of this exact presentation in case you would like to listen again and or share with some friends and colleagues. Lastly, the series is a result of numerous surveys. As always, we encourage all of you to complete our 1 to 2 minute survey to provide feedback on what you thought of today's presentation, as well as any future topics you might like to see from us in the past as we plan for our next January and then April webinar series. With that, let me pass it over to our panelists for introductions. Keith. You're muted, Keith.
Keith, you're muted.
You're muted. Zoom technical difficulties.
I'm so glad you're a techie, Chad. Thank you for that. Well, okay, thank you everyone for attending today's webcast on distribution strategies in retirement. This is Keith Johnson. I'm a certified financial planner and senior education specialist with Benefit Financial Services Group. For those of you not familiar with BFSG, we are a fiduciary consultant. We help retirement plan sponsors and committees oversee their organization's retirement plans, and we've been doing it since 1991. So presenting with me today is another BFSG associate, Paul. Paul, why don't you take a moment to introduce yourself?
Yeah, glad to be here again, Keith. Again, my name is Paul Horn, Senior Financial Planner with Benefit Financial Services Group, part of our wealth management team, helping clients grow, manage, and protect their assets. Pleasure to be here.
Thanks, Paul. So on the next slide here, if we take a look at our topic, when we talk about distribution strategies, it's really all about building retirement security. And what does that mean for you? Obviously, taking care of your essential expenses for as long as you live and providing for your spouse, your loved ones. But for most of us, you'll probably want to have enough saved so that you can actually enjoy retirement. So have you thought about what you'd like to do in retirement? I ask this because the average retiree watches 48 hours of TV per week. So with that being said, I think we're going to pause here. We have a poll to find out what's on your mind, all the folks on the call today, as you look forward to retirement. So at this point, I'll turn it back over to Chad.
Yeah, thanks, Keith. So our first poll, just life in retirement, is what are you planning to do in retirement? Meant to be a fun poll. Let me launch polling now. I'll leave it up for about 20 seconds before I close results. I will share them with the group. We only have a handful of answers, so I know many of you will choose the last answer, which is much more than what I put on the screen. So with most people having already voted, let me close polling right now. I will share the results, and we have a resounding 78% say travel, nearly 50% say they're going to volunteer. Doesn't sound like we got a lot of golfers on the line with only 2%, but over 20% saying they want to spend time with grandchildren, 16% comfy couch with big screen TV. Sounds like they want to continue this COVID environment with Netflix and Prime Video. And then 65% say your list is basically not good enough. I have a ton of other things I'd rather do. With that, let me stop sharing results and I'll give it back to Keith and Paul.
I'm very surprised here, Paul, before we go to that next slide, we didn't have a single Walmart greeter on this call. I think that's all right.
Good to see. All right, so when we're talking about retirement, there's a lot of things that we can control. One of the things that we can't control is simply known as sequence risk. Sequence risk simply means having bad luck at the timing of your retirement. Imagine retiring here with the markets doing really well, and then in that first year of retirement, watching the markets drop. Probably going to make you very uneasy, might make it hard to sleep at night. So this is a real risk, and this is something that retirees unfortunately cannot control. Real life story here. My father-in-law back in 2008, you guys may remember the real estate bubble that burst that year. My father-in-law was set to retire that year. He actually had to delay his retirement about 18 months just because he simply had bad luck on the timing of retirement. He wasn't comfortable retiring in the middle of 2008 with the market dropping over 40% in his portfolio. So fortunately, that happens from time to time, but this is an important consideration, and that's why we're talking about a lot of things that you can control today, because there is just, unfortunately, sometimes just simply bad luck. You know, it's interesting because most people psychologically would rather retire here when the markets are high, but actually retiring here in the yellow when the markets are low is actually a pretty good time to retire, because a lot of times the markets are going to continue to grow from that point.
I think one thing to mention here, this is normal, right, Paul? I mean, somebody retiring, you're going to experience these corrections, bear markets over the course of your retirement. And you're actually, when you stop and think about this, your retirement, you might spend more years in retirement than actually working, with life expectancy increasing.
It's quite possible, yeah, Keith. And, you know, naturally people get more conservative in their investments as they approach retirement, which is a good thing, because that does help protect your portfolio in case of this sort of bad luck. So, but certainly with the uncertainties ahead, we definitely need a strategy.
Absolutely.
All right, so let's go ahead and talk about 3 different strategies for drawing down your retirement savings. The first one is called flooring. This is really just making sure that you have a base level of income to meet your basic needs in retirement. So if you need $2,000 a month to pay your bills and keep the electricity on and keep food on the table, then then this type of strategy is trying to make sure that you have that guaranteed income of at least $2,000 a month, whether that's a pension, Social Security, things like that. Another one is systematic withdrawals. This is using your investments for income in retirement. And this, how much you withdraw is a factor on the other income sources that you have and the value of your portfolio. And then the last one is called segmenting or bucketing your investments in retirement. And the idea with this strategy is you invest your money essentially in different buckets for different time frames when you may need the money. So for example, maybe you're 5 years from retirement, and when you retire, maybe you want to buy a second home. Because you're going to be using maybe a down payment for a second home at that retirement in 5 years, that money should be invested moderately conservative to conservative because you have a shorter time span than say your retirement money, which will be used throughout your retirement. So that has a longer time frame, so you can be more aggressive with that bucket of money. So that's just kind of an example there.
I think one goal to consider is building a retirement plan that results in your ability to essentially cover your fixed expenses month to month from guaranteed income sources like pensions or Social Security, and then the ability to cover your variable or discretionary expenses with self-directed accounts like IRAs, 401ks, 403bs, 457s. So your must-have expenses are those that are necessary to maintain a comfortable standard of living. The idea is to project what your income sources will provide, then identify if there's a gap. So if you have a gap or a shortage, this is definitely a conversation to have with a qualified financial advisor. Now, if you're in a position where you're able to pay your fixed expenses from your assured lifetime income streams, like Social Security or pensions, and then your variable expenses from your self-directed accounts, you are in a great position going into retirement. Now, when we talk about distribution strategies in retirement, one widely cited rule of thumb is to withdraw 4% of your assets in your initial year of retirement. And then from there, you adjust it by inflation on an annual basis, whatever that may be. So for example, if you withdraw 4% at the beginning of year one, and then increase that amount by inflation during the previous year, beginning in year two. So if we take a look here, let's say the value of your retirement assets, it's $100,000 at retirement. So the amount you would withdraw in year one would be about $4,000 or 4%. Then you might withdraw it at the beginning of the year based on 3% in year two. So if we do the math, 3% of 4,000 is $120. Then $120 plus 4,000 is $4,120. That would be in year two. So if this seems like the strategy for you, it's important to rebalance your portfolio, and we'll talk a little bit more about that, just to ensure you continue to stay in line with your tolerance for investing.
Yeah, and the 4% rule is an age-old rule. The whole reason the 4% rule exists is because studies were done, and it showed that if someone spent about 4% of their assets, they had a very low probability that they would run out of money throughout retirement. So the 4% rule is a good rule of thumb and a good starting point for people that are retiring.
100%. And even to piggyback off that, the rule is based on 57 rolling 30-year periods with a wide range of market and economic conditions, anything that's happened in history. The only period that it failed was when 1969 was a starting point. Because of the high inflation in the 1970s, that required higher withdrawal rates in the early years. When that was happening, returns were essentially subpar during that time frame. So some of the cons here, if you follow it exactly, it's very inflexible. Meaning, are you actually going to go in and adjust your withdrawals for inflation? Maybe not downsize your spending if you're facing these types of losses. Because what we don't want, you don't want your livelihood tied to what the stock market is doing throughout retirement, because you're going to see those peaks and valleys as Paul showed us earlier on.
Yeah, and a good strategy if you're looking at something like the 4% rule is taking advantage when you do have those peaks. So if you have a good year, maybe enjoy and take out some of that extra money, and that's a good year to take that trip to Europe that you've been planning, buying that new car, doing that home remodel in those good years. But when you have those down years, you may want to take out less of that money just so you have more money in the portfolio, allowing it to recover and grow to future value and give you more money in the future.
Yep, absolutely. So it's all about flexibility, as Paul had said. So ideally, if your investments are performing poorly, you want to adjust that amount down. And like Paul said, if things are doing well in the market, yeah, you could take that trip. You can spend a little bit more, but again, it's all about building in that flexibility if you're looking to adhere to the 4% rule. So speaking of performance here, the markets are going up and down. How you're invested, that has a direct impact on how long your assets will last throughout retirement. So for example, withdrawing 4% from a portfolio comprised of 100% cash, it's not going to last nearly as long as a diversified portfolio with stocks and bonds and so on and so forth. And we do have our investment guy on here. Chad, you want to add anything to that?
Yeah, I think that yes, it's important to kind of stay your course, and behavioral finance has become a huge topic. If you're invested, if you're purely in cash and all of your money's in your savings account, I don't know about all of you, but my Wells Fargo and Chase savings account right now are paying 0.01%. When you think about inflation, even with low inflation of 1.5% to 2% right now, that technically means that every year that savings account is worth less money. I think back to when I was a child, an In-N-Out double or a Big Mac cost $1.50, $2. And today, while the burgers have become smaller, maybe like 50% the size, the price is more than doubled. I think a double is like $3.50 or $4 today. Right, so if you think about that, if the cost of the goods and services you're purchasing are always increasing in cost, and your money is only growing at 0.01% of your savings account, that's a negative return. So you're having a balanced portfolio, investing a little bit in the stock market, some in the bond market, a little bit safer, definitely a prudent strategy. Just sticking to your strategy over the long term and adjusting your plan with your financial planner, definitely prudent as you look towards retirement.
Yeah, we don't want to deviate from that. Okay, then on the next slide here, thank you, Paul. Another distribution strategy is to divide your money among investments with different levels of risk according to when you think you'll actually need it. So with this strategy, you would want to withdraw from the lower risk portions first. So this is also known as the bucket strategy. The lower risk portion might have your expected expenses for, say, maybe the next 3 to 5 years. So you separate out your investment money from dollars that need to stay safe and liquid. So here we're thinking about cash, CDs, tips, so on and so forth. Going forward, you would replenish those lower risk portions from higher risk assets. So we're talking about stock investments that have increased in value. So you maintain about 3 to 5 years worth of expenses in the safe and liquid investments. So lastly, with this strategy within the higher risk portion, the stocks, you would want to rebalance or transfer from your stocks to bonds in years where stocks have done really well and bonds didn't. And then vice versa, you just want to make sure that you stay within your risk tolerance for investing. What are some of the pros here? Well, there's a psychological benefit, I guess you could say. Can help you avoid selling in a panic by knowing the strategy and then labeling those accounts for short-term, mid-term, and long-term goals. So it can help you understand what the money is for and how to manage it and then react to these market movements. So it's basically a way for an investor to rebalance that might be easier to tolerate and execute versus essentially buying what has declined in a down market and then selling what is gained from a regularly allocated portfolio. Some of the cons, it does take a little more time and effort to manage. And this is really key in all of this, if you set it and forget the buckets, your portfolio could gradually and most likely will move outside of your tolerance for investing, depending on the performance of the stock market. So in discussing this, which strategy is right for you? So if you've saved a lot or you have high levels of guaranteed or assured lifetime income streams, you have extra flexibility. So I think Paul mentioned this, start by considering the 4% rule first, then monitoring and adjusting along the way, as we talked about. You also might play it safe, maybe spend a little bit less, as Paul had mentioned, and talking about spending and what expenses might be unexpected in retirement. I think we have our next poll here.
We do. Thank you, Keith. So our next poll is just thinking about healthcare costs in retirement. When we think about inflation, healthcare costs, is one of the higher inflation categories, costs increasing more than almost any other category in the marketplace. So I think just a fun poll, on average, how much would a typical healthy couple spend on healthcare in retirement? Let me launch polling right now. Again, I'll leave it up for about 20 seconds as we gather everybody's guesses on the correct answer. So with most responses in, let me close polling right now. We got a really smart group. So we got a split between 100,000 at 33% of the vote and 300,000 at 33% of the vote. 13% split also say 200 and 400,000, and then 4% say 500, and a few people out there saying about $1 million. So the correct answer from a recent Fidelity poll is about $300,000 is what a healthy couple will spend throughout retirement on healthcare expenses. That, let me stop sharing results, and I'll give it back to Keith and Paul.
Thanks, Chad.
All right, so let's talk about if there's the concern that you didn't save enough. Well, when it comes to retirement planning, there's really 3 different options that you have. You can either make more money, spend less, or die sooner. Now, no one here is going to choose that third option. So let's talk about ways of maybe making more or spending less. Out of these 2 options, the most important one to focus on is spending less. The lower your expenses are each year, the easier it is to use, for example, for using that sort of the layered approach here of having some guaranteed income to meet your basic needs. So if you're trying to minimize things and minimize costs in retirement to help put you in a good position, things you want to make sure is you're planning for those healthcare costs like we just talked about. For most individuals, that is the most expensive thing they pay for in retirement. You're going to want to make sure that you have adequate sort of long-term care insurance. This is the biggest what if. We're seeing a rise in Alzheimer's and dementia, so the need for long-term care is growing. The average stay in a long-term care facility currently is about 2.5 years, and the average cost for a single bedroom facility is about $6,000 a month currently across the U.S. Try and maintain proper liability coverage. So if you get an accident or just life happens, you want to make sure that you're covered there. And then simply just avoid debt. I know this is pretty basic and stuff, but realistically, the people that I'm working with, I've had people from every walk of life that have been able to retire comfortably. And why they can retire comfortably is because they have good financial habits. So it's really starting with the basics and just building off that. If you guys take away one thing, controlling your expenses is one of the easiest ways to get there. As we talked about earlier, you want to layer your expenses or your income sources. Ideally, you have like a three-legged stool approach where you have income coming in from some sort of Social Security, have income coming in from another source, whether that's a pension, maybe you're working part-time in retirement, something like that. And then finally, the third leg of that stool would be your investment. So having that layered or multiple sources of income is another way to help meet your income needs.
And Chad, do we have our final interactive poll here?
We do. So let me pull up that poll right now. So this is just thinking about the order of pulling money. I think Paul gave you a preview real quick, so hopefully nobody was paying attention to that next slide. But generally speaking, most advisors would say that you should take money from which account first. Let me launch polling now. I'll leave it up for about 20 seconds again. But is that your taxable accounts, your Roth accounts, your pre-tax accounts, or your emergency savings? I think with most responses in, let me close polling again, and I will share results. And again, like we got a really smart group of right here. We have 50% say taxable accounts. That is the correct answer. 20% saying Roth, 28% saying pre-tax, and I think only 2% saying emergency savings, which would be one of the last places you like to pull money from. With that, let me give it back to Keith and Paul.
All right, great. Yeah, the general rule of thumb here is to defer paying as much in taxes as you can for as long as possible. So generally speaking, you would want to first withdraw from your taxable accounts. So then if you still need more, you would move on to taking from the tax deferred accounts, the 401s, 457s, IRAs, and only when you've used up all of the above would you want to withdraw from those Roth assets. So with a Roth account, you're allowing that account to grow essentially tax deferred, and everything comes out tax free if you have the account open for 5 years and age 59 and a half. So one consideration here when we talked about long-term care expenses and healthcare, if you have some major medical expense or some unforeseen expense late in retirement, you can kind of earmark that Roth account to pay for those expenses. Again, 5 years and age 59 and a half, you could fund that with tax-free dollars. So what's unique about the Roth account is that at age 72, with your 401s, 457s, IRAs, you're required to take a minimum distribution. That's not the case with the Roth. So it's basically balancing your tax liability. That money can continue to grow and grow with no required minimum distribution. So there's a strategy there as opposed to purchasing long-term care insurance. You can kind of earmark that Roth. And maybe Paul, you have anything to add to that? It's a really versatile account.
Yeah, absolutely. I mean, the general rule of thumb there, getting that tax-free growth is is ideal. So we want to take advantage of that as long as possible. And if you're planning on giving money to your heirs, giving them as much possible in the Roth account is a benefit to your heirs because they get that money tax-free versus the other accounts would be potentially taxable. The only thing I would add here too is depending on your tax bracket and your tax situation, what your income sources are, there may be times where you may want to use a little bit of your tax deferred accounts for income each year as well. So definitely work with a financial planner or a CPA when you're planning on taking your income in retirement.
100%. Yeah. So like Paul said, if you think you're going to be in a lower tax bracket year because of large medical expenses or charitable contributions, maybe consider taking a little bit more from the tax deferred accounts. Vice versa, if you think you'll be in a higher tax bracket, maybe you consider taking some of that Roth money. Another thing, if you own highly appreciated taxable investments, so outside of your retirement accounts, you may want to consider holding onto those in order for your heirs to get what's called a stepped up cost basis at death. So if you purchase the stock at $10, it's worth $100,000 or $100. Something happens to you and you gift that to your beneficiaries or heirs, they'll receive that stepped up cost basis of $100 and you won't have to pay anything in taxes. And then on the flip side, to make the best of a weak market, you may want to consider selling taxable investments just to get that tax loss offset. So I know this has been a ton of information. I understand that. And the bottom line is retirement planning and distribution strategies. It's definitely not a do-it-yourself project, which, as Paul had said, you definitely want to talk with tax professionals and financial folks. Okay. So just to kind of wrap it up here, with that being said, there is no one size fits all strategy, and there's no single best withdrawal strategy for everyone on this call. And I think Paul would agree when retirement planning, it's never finished. Measuring your progress and your success, this is an ongoing process.
I would absolutely agree. And it's quite common, for example, with clients that we have that are actively retired, we'll work with them at the beginning of each year and we'll put together a plan for them just to help them understand which buckets of money to pull from each year. Because remember that slide, we said mostly you want to take it out of the taxable account, and we still follow that. But there are times where you may want to consider taking more money out of a traditional account. Maybe you're in a lower tax bracket, or maybe that is your largest account and you're going to have large future RMDs. So there could be some reasons why you may want to take money out of that tax deferred account sooner than you might otherwise plan. So working with a professional to kind of layer that with you, they can help you understand the taxes and help you get your money in the most tax efficient manner.
Thanks, Paul. Just to kind of wrap it up here, then I would like to, number one, thank everyone for attending today's webcast. While Chad had mentioned we will be opening up today's session for questions, he had alluded to if you have something personal in nature, you would prefer to discuss this on a one-on-one basis with a planner. We are actually offering complimentary financial planning consultations to everyone on the call. So by going through this process, you'll receive a list of action items and an actual report with next step recommendations just to ensure that you're staying on track for retirement. And on the next slide, I'll introduce the team here. So this is our team of financial planners. We all hold the Certified Financial Planner designation. And I think that's important here because there are 300,000 people in this country calling themselves financial planners. Only about 17% are board certified. So this makes Paul, myself, we work in a fiduciary capacity. So it's always your best interests that come first by law. We don't sell any insurance or annuities or financial products. And all the planners here on the screen have at least 10 years of experience in the financial services industry. And everyone focuses on a variety of areas just to ensure we're able to meet the unique needs of all of our clients. So with that being said, I will turn it back over to Chad. We're at 10:30 here to see if we have any questions.
Great. Thank you, Keith and Paul, for the presentation. So again, before we start the Q&A, let me remind everybody, at the bottom of your Zoom screen, there is a Q&A box. Please continue to type questions. I have a number of questions already to ask, but please continue to type questions. We will continue to answer them until there are no questions left outstanding. And then also right next to the Q&A box, there's a chat box. I did post a few links there. One of them is a link to, again, our 1 to 2 minute survey. Another one is a link to the PDF of today's slide deck in case you'd like to download it to reference later. And then the last link is just to the back end of our website, BFSG University, for anybody that's interested in some other timely topics, especially the replays from year-end tax planning, charitable gifting that we did last week, as well as Social Security, Medicare, estate planning, and other things that we've done to date in 2020. So with that, let me get to our first question today. It goes back to the 4% withdrawal rule that you guys spoke to quite extensively. And do you think that's still valid today?
I think it's a good starting place. There are some recent studies that are done by Michael Fink and some other leading industry experts on this very topic, seeing if it's still valid today. And for the most part, it still holds up as a good rule of thumb. And remember, that's what it is. It's a good starting point. I would not base a whole financial plan or retirement plan off of that certain rule or just that strategy alone.
Good starting point. That's exactly right. I would agree 100%.
Great. So the next question we have is, do you recommend to move investments from aggressive to conservative if you're going to be retiring in 5 years?
Well, I guess the question would be, are you going to be withdrawing those assets? That would be the first question I would ask, because a lot of folks, if you have your 401, your company plan, whatever the case, if you're not going to have to tap that until you're required to at age 72, your window might be much longer. But I think generally speaking, you do want to get a little more conservative as you get closer to retirement. I don't think we went through this. There's the rule of 110. What is it? Has that changed, Paul, now? Is it a different rule?
No, it's still about the same, I think.
Yeah. So, I mean, the rule of 110, and again, this is a rule of thumb, just to take 110 minus what your age is, and whatever that number is, that's approximately what you should have invested in the stock market or the equity market just to outpace inflation and taxes. So that's also a good starting point.
Yeah, and again, that's a good rule of thumb or a good starting point. When we look at retirement planning, really think of it like a mountain, right? You have the part that you're going up on the mountain, and you have the part that's coming down. That peak is retirement. So as you're saving for retirement, you can be very aggressive because you're climbing that peak. You're still accumulating your assets. But once you get closer to that peak and you hit retirement, now we're in that distribution phase where you're beginning to spend down your assets. It's as you get closer to that peak, you're gonna naturally want to move the investments more conservative. However, this is all relative. If you are someone that's a conservative investor, maybe your comfort level is only 30% stock, 70% bonds, for example. You don't necessarily need to become more conservative as you approach retirement. I mean, keep in mind the average portfolio for a retiree is 60% stocks, 40% bonds. So this question is kind of hard to answer because it's kind of relative to what is your risk tolerance. If you are an aggressive investor, someone that's like 80% stocks or higher, then yes, it would make sense to begin to move more conservative as you approach retirement.
Actually, that's great, Paul. Thank you. And I was thinking now, Chad, we're able to offer, if you don't understand what your risk tolerance is, we can take you through a process where you complete an assessment, which will literally take less than 5 minutes, and then provide you with a report and recommendations as to how you should be allocated. And I think, Chad, are you able to drop something in the chat box, or can we do that?
Yep. Yeah. So I'll drop it in the chat box in just a minute as you guys are answering the next couple of questions. It's loading up on my second screen right now. So stay tuned. I'll let everybody know when that is available in the chat box. I think it's a quick 5-minute thing. You put your name, you put your email, and you fill out a quick survey. There's no credit card or charge or any of that kind of stuff that's required for it. You're not put in a spam list or any of that kind of stuff. So the next question we have, I'm going to do two at the same time. So one is, can you put up the phone numbers? I think you just put that up, Keith, for somebody looking to make an appointment with the CFP. And then, another one goes back to that 4% withdrawal rate. Are you talking about 4% for the whole year or monthly?
You would have the flexibility.
That would be,
if you wanted to take out 4% of your portfolio at the beginning of the year, putting it into a savings account and withdrawing from there, or periodically. So that's more of a, it depends answer.
well, it's 4% of the portfolio per year. How you take out that 4% is up to you.
Right. Yep.
Awesome. So I did just post the link for anybody you're looking for that free risk assessment. It's the back end of our website, hiddenlevers.com. That is in the chat box right now. And so as I get to our next question, are there any implications because of state taxes, thinking about, the buckets you take money out of, or if you take Social Security early or late, can you kind of speak to some of those considerations?
Yeah, those two separate considerations there. If you are taking your Social Security early, that means that you have an income source already in retirement. And if you take withdrawals from your tax deferred accounts and you take too much out, you could actually have to pay taxes on that Social Security benefit possibly. So speaking to the Social Security first, this is why it's good to work with like a tax professional or a financial planner, so you can understand the tax implications of the withdrawals there. State taxes are also absolutely a consideration. I mean, for those of us that live in California here, we pay the sunshine tax. We pay one of the highest tax rates in the country. So that absolutely is something to take into consideration, especially because long-term capital gains on taxable accounts are taxed at ordinary income tax rates. We don't get a special discount there like most people do.
Yeah, I would say probably 99% of the folks that we work with, their Social Security benefit is taxed at 85%. It's not an 85% tax, but let's say you have a $1,000 Social Security benefit, $850 of that will be taxed at whatever your tax rate is. So there are a lot of considerations surrounding when to do that.
Yeah, so we have a number of questions in the Q&A box. I'm going to pull one over from the chat box real quick. And it's really, how much should you have already saved for retirement? Saying, I think somebody read an article that says you should have about 6 times your income saved by the age of 50.
All right. This one is really a difficult question to answer, guys, and because it's based on your lifestyle. So I think we can all agree. We've seen celebrities that make millions of dollars a year. They show that you can make as much money as you can, but you can still be broke if you have bad spending habits. So to answer this question, I'm not trying to not answer it. It's just really difficult because what kind of lifestyle are you living in retirement? If you plan on sailing on yachts and traveling to Europe for 6 months, you're going to need a lot more than that. And if your plan is to buy 3 acres, in Montana and just live a very low-key life, that's great, but that's going to obviously have very different costs associated with it.
And another general rule of thumb here is the 80% rule. So experts agree you should have about 80% of your pre-retirement income available to you in retirement in order to maintain your current standard of living. So it's essentially, okay, what are you spending right now? And what will your income sources be in retirement? And taking that approach as well. But again, it is difficult to answer with everyone on the call because everyone's situation is totally unique.
Yep. Thanks, guys. So then also, can you expand on the step up on family, you think trust AB and where real property investments and equities should be held in trusts?
Okay. So we touched on this a little bit in the first webinar that we did in this series on year-end tax planning. But when we look at different accounts from a estate planning perspective, so what's going to go to your heirs upon your death? If the money is in a taxable account, so this would be an account that's held in your name, held in the name of a trust, or maybe a joint account if you're married, those accounts will get what's called a step up in basis. So your heirs will receive that money, and their tax basis, what is used to determine their taxes on that account, will become the account value at the date of your death. So maybe you have an investment account that's worth $200,000, but your basis is let's say $120,000. So you have $80,000 in gains, and then you pass away. The money goes to your kids. Your kids would inherit that with a $200,000 cost basis. So if they sold everything right away, they wouldn't have to pay taxes. But the advantage there is that helps reduce taxes for the heirs. If we look at tax deferred accounts, so these are going to be your traditional IRAs, traditional 401ks or 403bs, as an example, money that's growing tax deferred that's never seen taxes. Upon your death, they will have to take the money, your heirs will have to take the money out of these accounts within 10 years. If it's going to the spouse, it's a little different, but if it's going to anyone other than the spouse, that money would have to be taken out of those accounts within 10 years of your date of death. And each distribution that they take would be subject to taxes at your heirs' income tax rate. And then finally, the Roth accounts are also subject to that 10-year rule, meaning when you pass away, your heirs will have to take the money out within 10 years with your date of death. But the Roth is all tax-free, so the money will go to your heirs tax-free.
Yep. Awesome. Thanks, guys. So I'm going to skip down the Q&A real quick, just because it's a really fast one. I'll get back to what I think is going to be a little bit longer answer. But somebody asking, they thought the age for RMDs or required minimum distributions was age 70 and a half. And just to clear that one up, that did change for anybody retiring after January 1st of this year, 2020. Part of the Secure Act was to increase the age for RMDs to age 72. Really just the government's recognition that people are living longer and probably don't want to start drawing down on their savings quite so early at 70 and a half. So if you retired prior to 2020, age 70 and a half is the age for RMDs, and anybody retiring after January 1st, 2020, the age for RMDs is age 72. With that, my next question gets into my investments are really high right now, right? The market's at all-time highs, but I'm planning to retire in about 3 years. I was thinking about placing my money in a savings type account and then continuing to invest moderately for the remaining 3 years. That way I have some guaranteed funds. Can you guys speak to your thoughts on that at all?
I think from an investment management perspective, I mean, we're not market timers. I mean, you can trace the stock market back 200 years, the New York Stock Exchange. And in any 13-year rolling average, so like 1970 to 83, 71 to 84, the markets have never been down. And we talked a little bit about volatility is normal, but it's short term at the same time. So to wholesale move from the market into savings, especially where interest rates are right now, again, depending on what your risk tolerance is, may or may not be feasible, in my opinion. But Paul, you can probably add something to that.
No, I would agree. Chad, spoke earlier where, savings accounts right now are paying less than inflation. And with inflation each year, you're getting a negative return on that money. This is money that you're planning on using for your retirement income needs. You should at least try and outpace inflation a year at minimum, just to maintain the same purchasing power with that money. I would strongly recommend maybe starting with that complementary risk analysis that we do to kind of get a better idea as to your willingness to accept risk. And if you combine that with a financial plan, that would give you a better understanding of your ability to accept risk. Because at the end of the day, I view risk like I view cake on a counter. Just because it's there doesn't mean I need to eat it. Risk is the same way. Just because we have the ability to take risk, we maybe don't need to. So starting there, I think, would be the best way to help better answer that question for you.
Yeah, let me tack onto that. It's an example I use very frequently. But think about somebody that taking a ton of risk, invested fully in the S&P 500. During the financial crisis, your assets, if you had $100,000, would have been down about 50%, over 15 months. So that $100,000 down to $50,000. Now, if you did nothing, if you just left it alone, 4 years later, it would have been back to whole, $100,000. But if instead you had been invested in like a 60% stock, 40% bond portfolio, your portfolio only would have been down about 25 to 30%. So if you think about that, I think a lot of people at near the bottom, having lost already 40 to 50%, went to cash. They were in cash. They stayed in cash for the next 4 or 5 years as the market recovered. And then 5 years later, they're kind of scared, saying, "No, the market's at all-time highs again. I don't want to put my cash back into work because I don't want to put it back in just to lose again." And then 5 years after that, the market had been on a more than 10-year bull market, the longest in 120 years. And they'd been sitting in cash, having already recognized all those losses from the financial crisis and not recognizing any of the gains that came afterwards. So thinking about just good investing behavior and staying in the chorus, had you been invested in that more diversified portfolio, you only would have lost 25%. And for somebody that recognized a 40% loss, that means when they lost 25%, they still didn't cash out. Right? So had you been invested according to your risk tolerance, you never would have cashed out. You never would have been in cash. You would have been invested, and that 60-40 portfolio actually recovered in only 2 years. You would have been made whole, and it would have continued to grow throughout the ensuing bull market. So definitely taking a risk tolerance, understanding your risk tolerance and your needs and what you expect in retirement, definitely prudent practice. With that, getting to our next question, and this is a little bit outside of this topic, distribution strategies, but can you talk a little bit about target date funds and the equity glide path?
That's right up your alley, isn't it, Chad?
I'm happy to take that if you guys would like me to.
Go for it.
Got it. Yeah. So I'm going to tie this up with 2 questions because one, the next one I have is having a 401k investments apply to target date funds and the 60-40. So the idea of target date funds, for anybody that's not familiar with them, is you pick the age, say whatever series it is, and there's a year that says 2020 or 2030 or 2040 at the end of it. You pick the year that most closely aligns to the year that you would turn age 65. And the idea is your target date provider, be it Vanguard, Fidelity, T. Rowe Price, whoever it happens to be, is then managing that portfolio, assuming that it's 100% of your retirement nest egg. And they're going to give you the approximate amount of equity and bonds or fixed income that applies to somebody that's about your age. And they will, over time, make that portfolio more conservative for you in what's called their equity glide path. Right. So think, a young investor planning, 25 years old to retire in the year 2060 might have 90% equity. But then somebody that's retiring in the year 2025 might only have 50 or 60% equity, depending on the target date fund provider and their analysis of the marketplace and their expectations for future growth in the equity markets. And so the idea is that you're now trusting the target date provider to give you the correct balance of stocks and bonds based on your retirement age. And again, they will make it more conservative, into retirement. And as you retire, many of these providers have what's called the 30-year extension. So anywhere from 7 to 30 years that they will continue to get you more conservative as you work into retirement, ending, call it age 95 at around 20 to 30%, in equities. Again, a lot of people, target date funds are a great solution, especially for the younger demographic of people in retirement plans, 401ks, IRAs, et cetera. As you get closer to retirement and you're really thinking about your spending needs, many people then start to seek out the help of a financial advisor, a financial planner, to determine, is this really the best, place for me to invest to achieve my long-term savings objectives and financial needs.
And you may have mentioned it, but they rebalance as well, right?
They do. So they rebalance, almost every single day, actually, the target date fund providers. So basically you're entrusting them to manage your portfolios. They're buying a ton of different diverse mutual funds of stocks, both also bonds. Several of them will hold real estate and commodities as well as an inflation hedge. But they are definitely a comprehensive solution to finding that right balance between equities and bonds in your portfolio, meant for the investor that's kind of a do it for me. And not at the stage where it makes sense to work with a financial planner. When you have a more complex situation and maybe you have an estate or a trust, you have multiple different types of accounts and buckets, then a target date fund might not be the best solution. It is a very basic type of investment option meant to encourage good practices. When you get some of these more complex situations, definitely worthwhile to seek the counsel of a financial planner, work with your accountant, as well, your CPA, to work on your tax situation and figure out the best buckets to have your money in. With that, next question is, would you recommend consolidating all of your investments into one account, such as your 401k, an IRA, or a Roth IRA?
I think life is complex enough. We can probably agree with that. So simplicity is good. So in retirement, maybe looking to combine like type of accounts. So for example, if you have a bunch of tax deferred accounts with like 3 different employers, combining those could potentially be helpful because it makes it easier to manage from an investment perspective, easier to track when you're subject to those required minimum distributions at age 72. So simplicity can be good. You don't want to combine things like a taxable account into an IRA or an IRA into a Roth IRA because that would create a taxable event. So you want to match the underlying tax strategy for each account. So if it's a taxable account, combine all your taxable accounts. If it's a tax deferred accounts, maybe combine all your tax deferred accounts. If it's a Roth account, combine all your Roth accounts. Now, with that being said, that doesn't necessarily mean to take the money out of your 401k and put it into an IRA at retirement, because there are some important considerations there. For example, for asset protection, if you're concerned about creditors or bankruptcy filing, you get better protection in your employer-sponsored retirement plan. If you're retiring early, if you retire between the age of 55 and age 60, you can take money out of your 401k penalty-free, but you don't get that same benefit with an IRA. So again, this is where talking with a professional can just help you identify maybe those one-off situations where it may not be in your best interest to consolidate.
And well, Chad, you could probably lend to this as well. You want to look at your plan. What are the expenses, the underlying fees, the investment options, and all that, right?
Yeah, exactly. So, I mean, my side guys, I know these two are talking a lot because they're on the wealth management side of financial planning, but I work on the institutional services side at BFSG, helping employers with their retirement plans. So working with many of you on this call, your retirement plans as well. We have a lot of participants here. And the idea of what we do on the institutional side is make sure that the investment options are all performing really well. We exchange them when necessary, make sure that the fee structure for those investments as well as the plan is as low as possible. From a fiduciary capacity, making sure that your participants aren't paying too much, either for the plan services or for the investment options. And in employer-sponsored retirement plans, since it's a pool of all the employees' assets, employer-sponsored plans have access to the exact same funds that you would have access to in your IRA or your brokerage account, but often at lower cost, right? Because an employer-sponsored plan is several millions of dollars, where you might only have $1 million or $2 million in your IRA, maybe even less. And so you're taking a 20, 50, or $100 million retirement plan. Those economies of scale mean that these plans qualify for the exact same fund, but with lower expenses. What that means is higher returns. So you might buy the exact same investment option in your IRA that's available in your 401k, and you might pay more in fees just because your balance is smaller than the 401k, in aggregate with all of your employees, combined together. So definitely something to think about. In some cases, it is the right choice to move your money from your 401k to an IRA. Think RMDs are required from a 401k in the Roth bucket or the pre-tax bucket, but RMDs are not required from your Roth IRA, right? So there is definitely some situations where it makes sense to pull your money from your 401k to your IRA, but definitely work with your financial planner, talk to your accountant, and figure out the solution that's right for you, and look at it holistically. With that, and this is our last question, unless another question does come in, can you please repeat what you said about paying taxes on your Social Security benefits when you start withdrawing?
Absolutely. So if you are single, okay, and you make less than $25,000 in taxable income per year, you do not have to pay taxes on Social Security. The reality is, if you're single and you live in California, you're probably making more than $25,000 per year. Okay, so if you're single and you make between $25,000 and $35,000, 50% of your Social Security's benefits are subject to taxes. Now, you're not paying 50% taxes on that. It means 50% is subject to taxes. So, for example, let's say your benefit each month is $2,000. Well, if your Social Security benefit is $2,000 a month, but you're in that range of $25,000 to $34,000 total income, then half of your benefit, which would be $1,000, would be subject to taxes. So let's say you're in the 12% tax bracket, then you multiply that, and that would be your taxes there. So your Social Security benefits, a portion of them may be taxable based on your overall income. If you're married, if you make more than $32,000 combined per year, your Social Security benefits will be subject to taxes depending on how much you make.
I think one last thing on Social Security here. We get the question all the time, when should you take it, right? If you're someone, you've been a good saver, you have multiple accounts, you're not going to need Social Security throughout retirement, you actually may want to consider taking it as soon as you can get it, which is age 62. If you're someone where your primary benefit is going to be Social Security throughout retirement, you may want to consider deferring that until age 70, because each year after full retirement age, your benefit increases by 8%. So there are like 1,000 different Social Security calculators out there on the web. All would probably suggest taking it at age 70. So why would I say this? Something called legislative risk. So 10, 15 years into the future, the government might say, okay, because Social Security is not in the best of shape right now. They could look at you, your age class, and say, you don't need all your Social Security benefit. So we're going to move it over to Joe Smith, who hasn't saved so well. So what's that called? It's called means testing. And they're actually talking about this as one of the alternatives to essentially try to save Social Security. So with Social Security, please contact us if you have questions as to timing and when to take it. We did a webinar over the summer, guys, with a woman named Yolanda York. She had been with the Social Security Administration for nearly 40 years. I don't think there's anybody that I've ever met that knows more on this topic than her. I would strongly recommend that you listen to the webinar. Reach out to us. We'd be happy to send you guys the link to that. It's completely free if you want to listen to it. There's pros and cons to every strategy with Social Security. No one philosophy is right all the time. So certainly listen to it and let's go from there. But it depends on your individual situation. That was a great session. Absolutely.
Yeah, hey guys, and so for all of you that do have the chat box open, if you look at that link, bfsg.com/BFSG University, that link, that replay link can be found there. It was from our summer series back in July of 2020. I mean, it seems a little bit daunting. It's a 90-minute webinar, but it was only about 30 minutes of content and then a 60-minute Q&A. So it was really a robust discussion, a lot of questions answered. I think that the idea behind Social Security is everybody says, okay, if I wait until 70, I get the most out. But at the end of the day, it's meant, especially if you're a couple, you're thinking about how can you maximize your cumulative benefit. So it might make sense for one of you to wait till 70, but one of you to start at 62, based on life expectancy, your family history. Definitely, having a Social Security analysis run for you would be a benefit to figure out how can you maximize your benefit, right? Not just get the most per month, but maximize your cumulative benefit between the two of you. So we did get, one more question came in. If you don't need to withdraw at your required minimum distribution age, does converting to an IRA to a Roth satisfy that distribution?
Roth conversion does not satisfy an RMD distribution. So if you have to take out $5,000 per year from your IRA, doing a Roth conversion of $5,000 will not meet that need. If you don't want the money or need the money for that required minimum distribution, the only option you really have is what's called a qualified charitable distribution, or QCD for short, where you could donate that money to a charity, and the money going directly to the charity would satisfy whatever portion you donate. That portion would satisfy your RMD for the year. That's really your only alternative other than taking the money out and paying taxes on it.
What can you do, Paul? Like up to $100,000, I think it is.
Correct. $100,000 per year is the max that you can do for the qualified charitable distributions.
Great, guys. So with that was our last question to you for today. So with that, right at the top of the hour too, I'd like to thank everybody for attending our webinar today. Again, please do fill out our survey. Let us know what you thought of the content today, as well as any additional topics that you might like to see in the future. As we continue our series, we will have a January series, which will be a very different type of BFSG webinar series. We have a couple of guest speakers, one on authentic happiness, so more like health and wellness than financial wellness. So definitely out of the box, something that you would not typically see from us being financial planning and investment consulting, but something I think that will be a really good value add for all of you that are tuning into our webinar series. With that, let me let's put up that disclosure real quick, Paul, and let me thank everybody for your attendance. We hope you guys all have a great day.
Thank you so much for attending.
Thanks, everyone.